You know that old app you keep around because it still solves one specific problem: saving a note, sending a huge file, posting a video, finding an event? Bending Spoons is built around that kind of app. It doesn't start with a shiny new idea. It buys products people already know, then tries to make them work harder. The company is Bending Spoons, and its stock market nickname or ticker is expected to be BSP. It's the kind of IPO the cursor stocks likes to slow down, because the story sounds familiar on the surface, but gets more interesting underneath. Can old apps become better businesses without pushing loyal users away? Bending Spoons was founded in 2013 and is based in Milan, led by CEO and co-founder Luca Ferrari. The origin story matters because this isn't a giant U.S. software empire buying side projects. It's an Italian company that became known for buying established digital products and running them for the long term. Think of Bending Spoons as a home for apps that already have users, but may need cleaner software, sharper pricing, or tougher management. Its portfolio includes names like Evernote, Vimeo, WeTransfer, Meetup, Komoot, AOL, Brightcove, StreamYard, Remini, and Eventbrite. The company says it acquires these products to own and operate them, not flip them quickly. The problem it's solving is simple to understand. Popular apps can get old, messy, and expensive to run, even when people still need them. Bending Spoons believes it can bring in stronger engineering, payment systems, marketing tools, and product discipline, then turn that old app on your phone into a steadier money machine. The money engine is mostly subscriptions, according to reporting. That means users or businesses pay again and again, not just once. That's powerful when people stay, because revenue becomes more predictable. But it also creates the central question for this IPO. Can Bending Spoons improve these apps without making users feel squeezed? Now comes the IPO, the moment a private company starts selling pieces of itself on the stock market. Bending Spoons is set to list on the NASDAQ on June 29, 2026. The range is $26 to $28 per share, and the planned raise divided by the offered shares points to an expected price around $28. The company plans to offer about 58 million shares, which are tiny ownership pieces of the company. At the expected price, that would raise about $1.62 billion. That's real scale. Not a small startup passing the hat, but a company asking public investors to fund the next stage of a very active buying machine. Companies go public for a few practical reasons. They raise money, give early backers a path to cash out over time, and gain visibility. For Bending Spoons, visibility matters because its whole pitch is trust. If you're handing your notes, files, videos, or event tickets to these apps, you want the owner to be stable. The scale is already unusual. Bending Spoons says its products reach more than 1 billion registered users, more than 400 million monthly active users, and more than 7 million monthly paying customers. That's why this IPO grabs attention. A huge number of people already touch the portfolio, even if they don't know the parent company. Revenue is the money coming in before expenses, and Bending Spoons' top line has been growing fast. According to reporting tied to the filing, it reported about $1.31 billion of revenue in 2025, up 95% from the year before. That's the bull case starting to show up in actual dollars. The company also says it has pushed real product changes after buying these apps. Evernote got more than 200 features and improvements, Komoot more than 80, StreamYard more than 50, and Vimeo more than 30. That's Bending Spoons' argument. Old apps don't have to sit still if a focused owner keeps improving them. The why now is easy to see. Software subscriptions are everywhere, and many older apps still have loyal users. But not every legacy brand has the patience or talent to rebuild itself. If Bending Spoons can keep buying products with real audiences, then improve payments, pricing, speed, and features, the old app story can keep expanding. That sounds powerful. But here's the catch. The same moves that make a business healthier can annoy the people who loved the product before. Price changes, layoffs, new subscription rules, or removed features can turn a trusted app into something users complain about. The bet only works if enough people stay after the changes. Here's the financial reality. Revenue is how much flows in. Profit is whether the business keeps any of it after the bills are paid. We have a clear revenue growth story, but a final IPO valuation hasn't been set yet, and profit details aren't the clean headline here. So investors will focus hard on whether growth turns into durable earnings. Competition is scattered because Bending Spoons owns many different products. Vimeo fights for video customers, WeTransfer fights in file sharing, Eventbrite fights in ticketing, and Evernote fights in productivity. So the risk isn't one single rival. It's that every app in the portfolio has its own battlefield, and each one needs attention. This is the part investors will argue about. The expected IPO raise alone, about $1.62 billion, is larger than the company's reported 2025 revenue of about $1.31 billion. That doesn't make the IPO good or bad by itself. It just shows the market is being asked to fund a bigger future, not simply reward what exists today. Another thing to watch is who gets the IPO money. When a company sells new shares, cash goes into the business. When insiders sell, cash goes to existing owners. The available deal facts show the planned share sale and raise, but investors should still read the prospectus carefully for the final mix and any lockup, the waiting period before early holders can usually sell. After it lists, watch 3 plain signals. First, do paying customers keep growing? Second, do users accept the product changes instead of leaving? Third, does all that revenue start turning into profit? What is left after the bills are paid? Those answers matter more than the first day stock pop. So the balanced version is this. Bending Spoons owns apps millions of people already understand, and it has shown it can grow revenue fast. The doubt is whether a hard-charging operator can keep improving familiar products without damaging the trust that made them valuable. That's the whole IPO in one question. Next time you open an old app that still does one job well, you'll know what to look for. Who owns it? How it makes money? Whether users stay? And whether growth becomes profit. Tell me your take, follow the cursor stocks, and remember, this video is for information and education only, not financial advice.